of sales method of forecasting is one of the popular forecasting technique. Anytime you worry about financial forecasting, then we have to worry about the percentage of sales method of forecasting. But let me say that forecasting involves predetermining the future. You're looking at what is expected at a future date. That is forecasting. Forecasting the future financial requirements, for example. Forecasting the future sales. Forecasting the future profits. Forecasting, so it involves predetermining the value of the future values. Financial planning and forecasting, ladies and gentlemen, is one of the key functions of a finance manager. In a contemporary corporate setup, finance managers of organizations do forecasting. And therefore, financial planning and forecasting is basically one of these key managerial functions performed by finance managers in the context of a corporate setup. You know that finance managers of organizations perform a number of functions. Some of these functions are managerial finance functions, those ones which are routine financial functions. And therefore, financial planning and forecasting is one of these key functions that finance managers play in the context of a corporate setup. So it involves predetermining the firm's future financial requirements. Like when we use a cash budget in terms of financial planning, you're comparing the cash receipts and payments. We'll be comparing the cash receipts and payments. And of course, the objective is to be able to know whether the firm will have a cash surplus or a firm shall have a cash deficit. When you use a cash budget in financial planning, you'll be comparing the inflows and outflows per period. Inflows and outflows, maybe per month. Cash inflows and outflows per quarter, or the cash inflows and outflows per year, to be able to establish the net cash inflow or net cash outflow. And that forms the basis of planning. If a company expects to have a cash surplus, then of course they can utilize that surplus cash more profitably. If they expect to have a cash deficit, then of course finance managers will plan in advance on how to finance the deficit. That's the role of a cash budget. But now we have another method of forecasting referred to as percentage of sales method. Now, this method of forecasting, let me start by saying, is based on certain assumptions. So the beginning is for us to identify the main fundamental assumptions upon which the percentage of sales method of forecasting is based. One of these assumptions is that it's assumed that there is a direct relationship between sales and assets. It's assumed that there is a direct relationship between sales and assets. And when I talk about assets, what I mean, these are all assets of a firm. And I know you guys are aware that assets are classified into two. We have the current assets and we have the fixed assets, which fixed assets are sometimes referred to as the non-current assets. So one of the fundamental assumptions of the percentage of sales method is the assumption that a direct relationship exists between all assets and sales, which means if the firm's sales goes up, the firm's assets are expected similarly to go up. If the firm's sales goes down, the firm's assets value is expected to go down. That's an assumption. Whether that holds in practice is an area of debate. So since all sales, all assets are expected to have a direct relationship with sales, then a change in assets, a change in sales will cause a change in assets. And many times from the examination perspective, what you have seen, you'll be informed that sales have gone up, maybe by so much, by a certain percentage, or have increased by a certain amount. Now that a direct relationship exists between sales and assets, then how can we establish the change in assets arising from the change in sales? This is a question that we want to ask ourselves. If a direct relationship exists between assets and sales, and here we are saying that when sales goes up, the firm's assets will go up. The question that we are asking ourselves, if sales increases by 1 shilling, the firm's assets will increase by how much? If the firm's sales were to increase by 1 shilling, the firm's total assets will increase by how much? Now, for us to be able to answer that question, then we need to express all assets in the current statement of financial position as a percentage of sales. We have to express all assets in the most recent statement of financial position as a percentage of sales. And this is what you can see that I'm doing there. The value of machinery divided by sales times 100. Probably that will give you X%. The value of stock, the book value of stock divided by sales times 100 shall give you maybe Y%. The value of debtors, this is sometimes what we refer to as account receivable, divided by sales times 100. Probably you end up getting Z%. Furniture and fittings, divided by sales times 100. You'll end up getting something like K%. Assuming that these are the only assets that exist, the most recent statement of financial position, then we express each of those assets as a percentage of sales, and then you sum up these percentages. Like now we'll take X plus Y plus Z plus K. This shall give us a total of M%. Nafikiri tuko pamoja? Are you getting me loud and clear?
Yes.
Are you guys getting me loud and clear?
Yes.
Now, once assets in the most recent statement of financial position has been expressed as a percentage of sales, then you sum up those percentages, assuming that percent is M. Well, what you have to be very careful. Assuming the total percentages is M, then you could simply have said, that if you take total assets divided by sales times 100 shall give you this percentage direct. What I'm trying to say, ukiongeza all assets, total assets divided by sales. Of course, sales for the current financial year. Whatever answer you find, multiply by 100. This one could give you M% direct. Si ni kweli? Hapo mnaona? Mnaona hapo?
Yeah.
Yeah, so this percentage is a percentage that you can get directly if you sum up all your assets divided by sales times 100. But I don't advise you to take that shortcut, because when you are preparing a forecasted statement of financial position, you may be required to look for the X, the Y, the Z, and the K. So I advise that find those percentages in advance, because you are required to do a statement of financial position forecasted, and of course, you'll be required to capture those percentages. Now, if total assets divided by sales times 100 is equal to M%, it therefore means, hence, if you make total assets the subject of the formula, if you make total assets as the formula, if you express total assets in terms of the rest, then this is what you find. Total assets is equal to M of 100 of sales. So you equal sawa. If total assets over sales times 100 is equal to M%, implies the total assets is M% times sales. Si ni kweli? Je, tunakubaliana hapo? Tunakubaliana? Ama tukubaliane?
Yes.
And if that is the case, therefore, we can take an incremental approach now if total assets is M% times sales, then implies incremental total assets is M% times incremental sales. What I've done now, if this relationship exists and is assumed to exist, of course, this percentage will assume does not change, then incremental total assets will be M% times incremental sales. Remember the question I asked earlier. Now that sales and assets have a direct relationship, and we are assuming that a change in sales affects a change in assets. And if sales were to go up by 1 shilling, then assets will increase by how much? So this relationship helps us to answer that question. And that's why I'm saying that assuming that M% is 80%. When you did these percentages, you summed up and you find 80%. Somebody had typed for me, this is not coming. Assuming that in the above illustration, assuming that M% is 80%. M%, assuming that M% is equal to 80%. Once you worked out those percentages, you summed up ukapata 80%, then this can be interpreted as follows. And this can be interpreted as follows. This can be interpreted. Is that the spelling of interpreted? I don't think so. This can be interpreted as follows. That each 1 shilling additional sale requires to be supported by additional total assets of 80 cents, i.e., if sales increase by 1 shilling, the total assets shall increase by 80 cents. Speak up, non-Apple, what I'm trying to say. You guys seeing that? Kama hii ni 80%. 80% of 1 shilling ni ngapi? Additional sale. Ngapi? Ukichukua 80% of 1 shilling, hiyo inakupatia ngapi?
0.8.
0.8 shillings, eh? Now, that 0.8 shillings is 80 cents, isn't it? 0.8 shillings is 80 cents. Now, this percentage, the assumption does not change. So if sales goes up by 1 shilling, assuming this is 80%, 80% of a shilling is 0.8 shillings. Now, that means if sales goes up by a shilling, then the firm's assets will increase by 80 cents. Now, let me ask another question. How do you think the increase in assets will affect the firm's cash flow? Will it increase or reduce cash flow? The increase in assets, what effect does it have on cash flow of the firm?
Decrease.
Reduces cash, isn't it?
Yes.
It reduces cash. Or you may interpret it differently, that this increase in assets require financing, isn't it? The company needs to raise funds to support the increase in assets. And this is what I'm saying. So if your assets have gone up, the firm require to raise funds to finance the increase in assets. And this is the point I'm making here. Additional total assets require financing. Additional total assets require financing. So as we move on to the other assumptions, we're going to find out how we'll finance this increase in assets. Second assumption, it's assumed that all current liabilities will vary directly with sales. Notice I'm talking about current liabilities. So this one does not include long term. Hapa juu nilikuwa nimesema all assets. So the assumption of this method is that all current liabilities have a direct relationship with sales. Hence, if there's an increase in sales, then we expect an increase in current liabilities. The assumption is that a direct relationship exists between current liabilities and sales. And therefore, if we have an increase in the firm's sales, we expect the firm's current liabilities to increase. Now, we want to ask ourselves the same question we asked earlier. Now that a direct relationship exists between current liabilities and sales, and now that we expect the firm's current liabilities to increase if sales were to increase, then if the firm's sales were to increase by 1 shilling, again, if the firm's sales were to increase by 1 shilling, current liabilities will increase by how much? Now that's a question which is answered by expressing all current liabilities in the firm's current statement of financial position as a percentage of sales. Unaangalia the current statement of financial position. Pengine kuna creditors, divided by sales times 100, inakupatia A. Pengine kuna accrued expenses, divided by sales times 100, B%. Maybe we have other normal short-term loans, expressed as a percentage of sales times 100, maybe C%. Maybe we have corporation tax payable, divided by sales times 100. Once you have expressed all current liabilities as a percentage of sales, and sum up those percentages, and assuming this total is E%, then we can then infer that all current liabilities, if you sum up the value of all the current liabilities divided by sales times 100, that will give you E%. It goes without saying. And if you express current liabilities in terms of the rest, in other words, if you make it a subject, then current liabilities shall be E% times sales. Now, this percentage is a relationship that we assume exists and will not change. Hence, if you take the incremental approach to the estimation of current liabilities, then we say incremental current liabilities is E% times incremental sales. Now, this is the relationship, ladies and gentlemen, that shall help us to answer the question I posed to you. That if sales were to increase by 1 shilling, current liabilities will increase by so much. Now, assuming we know this percentage, E%, assuming it is 40%, assuming that percentage, E% is 40%, can be interpreted that for each additional 1 shilling sale, the firm's current liabilities will increase by 40 cents. If you take E%, which is assumed to be 40, times 1 shilling additional sale, then additional current liabilities will be shilling 0.4. Hiyo ni kweli. 40% of a shilling. Hiyo ni shilling 0.4.
Yes.
Now, that shilling 0.4 is the same thing as 40 cents, isn't it? Yeah. So if sales were to increase by 1 shilling, the firm's current liabilities will increase by 40 cents. Then the question again we want to ask ourselves, this increase in current liabilities has what effect on the firm's cash flow? How does it affect the firm's cash flow? Does it increase or reduce?
Increase.
It will increase the firm's cash flow, isn't it?
Yeah.
So that means that part of the additional sales is financed from the short-term sources. Hapa juu, tulikuwa tunasema assets will go up. Na nimewaambia hizo assets require financing. And now you can confirm from the second assumption that part of that increase in assets will be financed from the current, from the short-term sources by 40 cents. Sasa mkiangalia hapa juu, assets zilikuwa zime increase by what? From my interpretation here, 1 shilling additional share required, an extra assets of 80 cents. That's what we said. And the firm require to raise 80 cents to finance their assets. Part of these now has been financed. 40 cents. Remember, this is a source of cash inflow. It's an inflow. So if we need 80 cents to finance our assets, and we have already raised 40 cents from the short-term sources, that means we have a shortfall of how much?
40 cents.
Another 40 cents, isn't it? We were looking for 80 cents. We have already obtained 40 cents. Now we have to continue looking for another 40 cents. Okay?
Yeah.
So this one proceeds, and therefore, to the other assumptions that will be seen how to finance the other 40 cents. Please allow me to move to the third assumption. Number 3, it's assumed that no relationship exists between increase in sales and long-term liabilities. For that reason, long-term liabilities cannot be expressed as a percentage of sales. The assumption we don't have a direct relationship between long-term liabilities and the sales. So please don't express long-term liabilities as a percentage of sales. Number 4, no direct relationship exists between ordinary share capital and sales. Therefore, ordinary share capital and reserves cannot be expressed as percentage of sales. So I think I'm trying to combine assumption number 4 and 5. Existing reserve. Oh, sorry. Let me see that's a different one. Let me bring it here. It's assumed that no direct relation exists between ordinary share capital and reserves, stock reserves. Ordinary share capital, stock reserves, and sales. And therefore, ordinary share capital and reserves shall not be expressed as percentage of sales. Number 5, existing reserves shall not be utilized to support the increase in sales. Only retained earnings expected during the forecasting period will be utilized to support the increase in sales. Yeah, we assume that a firm cannot go to their reserves and find money from their reserves to support the increase in sales. So what we only capture is how much is forecasted. If we are forecasting financial requirements for the next 1 year, then capture retained earnings as at the end of that forecasting period. If you are forecasting for a period of more than 1 year, then capture the forecasted retained earnings as at the end of each period. So we are assuming that what the firm forecast to retain is what shall be utilized to finance the increase in sales, which of course will cause an increase in assets. Number 6. So here we already capture retained earnings as at the end of each forecasting period. Number 6, the after-tax net profit margin is known and will remain constant during the forecasting period. Notice, I'm talking about after-tax net profit margin. Yeah? I think when I was going through ratios analysis, I told you guys that this is one ratio. You'll find a number of formulas depending on where you're reading, but notice I'm talking about after-tax. So net profit after tax divided by sales times 100. If this ratio is not given in the current financial year, or you're not informed the firm's current after-tax net profit margin, then work it out. Look at the profit after tax divided by sales times 100. But the assumption here is that that profit ratio will remain constant. That profit ratio is known and will remain constant. So we shall use it to forecast the net income of the firm as at the end of each forecasting period. The firm's dividend payout ratio is known and will remain constant. Now, of course, we assume the firm adopts a constant dividend payout ratio, 40% payout or 60% payout. And therefore, we assume that that payout ratio is known and will remain constant. But it's not a must that this is the only dividend policy the farm adopts. When I went through in class, guys, I told you there are other policies the farm adopts. Stable, predictable policy, residual policy. You know, the examiner can want to mix you up. And I think the idea here is how much dividend is the company going to pay at the end of each forecasting period. Whichever policy the farm adopts, whether it's a payout ratio or a residual policy or stable, predictable, constant dividend per share. So capture the dividend payable. Once we have used the after-tax profit margin to establish the forecasted net profit after tax at the end of each forecasting period, then we work out the dividend payable so that we capture retained earnings. Forecasted profit after tax less forecasted dividend payable shall give us forecasted retained earnings. And these are the ones which I'm saying we assume. I've already said in number 4, only retained earnings expected during the forecasting period will be utilized to support the increase in sales. So you need to work out the forecasted profit after tax, the forecasted dividend payable, and then work out the forecasted retained earnings as at the end of each forecasting period. We don't go back to our reserves to check how much reserves are available to support the increase in sales. There will not be any change in value money. There will not be change in value money during the forecasting period. Now, do you guys agree with these assumptions? Do you think these assumptions hold in practice? And this is a question that I want to put here. Not application of these assumptions in reality is doubtful, and hence the limitations of this method of forecasting. If the examiner tells you talk about shortcomings of the percentage of sales method, then you critique those assumptions. Okay, now, when we're using this method of forecasting, there are steps to be followed. Number 1, determine the increase in sales, which a firm expects to realize during the forecasting period or periods. Of course, that one is very, very easy for you to get. If sales for the current year are 10 million, and sales will increase by 20%, then you will be able to know the total sales and look at the change. So sales for the current year is 30 million, will increase to 35 million. The change in this case will be 5 million. So determine the increase in sales. Number 2, determine the increase in total assets to arise due to increase in sales. Yeah, of course, that's why I've given you this relationship here. That's why I've given you this relationship here. That increase in total assets is M% times increase in sales. Once you have to express all assets as a percentage of sales, find that fixed percentage and find the incremental total assets. That is the second step. Incremental, find the incremental total assets. Arise during increases. Determine the incremental current liabilities will arise from the increase in sales. And that's why I've given you this relationship again. Incremental current liability is E% times incremental sales. We shall find the incremental current liabilities. Number 3, determine retained profits expected at the end of each forecasting period. At the end of each forecasting period. You know, you may forecast for a period of 1 year or 2 years or 3 years. So you are expected to establish the forecasted retained earnings at the end of each forecasting period. Now, I've already said this method is based on the belief that existing reserves are not available to support the increase in sales, which is not realistic. So we need to find the forecasted retained earnings at the end of each forecasting period. How do we find this forecasted retained profit? sijui kama hiyo formula mnaiona mzuri. Let me write it properly. Forecasted retained profit. Forecasted retained profit is a function of net profit after tax. Net profit after tax. Deduct net profit after tax. Deduct ordinary dividend. Of course, forecasted. Deduct ordinary dividend. Tunatoa ordinary dividend. Of course, this is forecasted net profit after tax. I think I should have used that one again. Yeah, it is forecasted net profit after tax divided by ordinary. That's why we need the constant. That's why we need the constant net profit margin that is assumed to be constant. So if you take that net profit margin times forecasted sales, total sales, will give you the total profit less dividend. If you know the payout ratio, I'm sure you can find the dividend payable. Now, this forecasted retained earnings is the one that is assumed that will be available to support the increase in sales. Retained earnings are a source of finance from internal sources, which will support additional sales. Then, number 5, determine external financial requirements as the amount which a company expects to raise from external sources to support the increase in sales. You see, if you check here keenly, once you've found the increase in assets, deduct increase in current liabilities, deduct retained earnings at the end of each forecasting period. Increase in assets less, increase in current liability less, forecasted retained earnings, anything, any shortfall that may arise is what will be raised from external sources through maybe long-term debt finance, or through the issue of a commercial paper, or through the issue of ordinary shares, and so forth and so on. But unless otherwise specified, I think I've already given some notes here. But if it's not specified how to raise money, the additional shortfall, then you may assume company will go for long-term debt finance. But I think I forgot to put number 6, prepare. Prepare a forecasted. Prepare a forecasted statement of financial position. Statement of financial position of the firm. Position of the firm. As at the end of the forecasting period. As at the end of the forecasting period. Or if you are doing many periods, then if it is 2 periods, as at the end of the 2-year period. And hence, carry out a financial analysis. Carry out a financial analysis of the firm. Financial analysis of the firm. Preferably using financial ratios. Your financial ratios tulifanya last time, discuss. Yeah, so once you have prepared a statement of financial position and you have the information, you can even continue to do a financial analysis using profitability ratios, using liquidity ratios, using efficiency ratios, and so forth and so on. Sasa, those are the stories which I wanted to give. I think we can now look at a small question in your past paper. We have your past paper. We can request you guys to go to this sitting. Although mimi naiona hapa, I typed it. The following statement of financial position relates Mageuzi Limited. The following statement of financial position, this must be relates. Wanasema hivyo kwa past paper. Relates. Mimi zina past paper hapa karibu na mimi. Hiyo mnaweza nisaidia kuona kama ni ukweli. Following statement of financial position relates to Mageuzi Limited on 31st December 2009. This is the most recent year, 31st December 2009. So it's a statement of financial position prepared as at 31st December 2009. Kuna fixed assets. Oh, they have not broken down those fixed assets. Total fixed assets. The total. I wish they broke down those assets. So hii haina breakdown ya hizo plant and machinery, furniture and fittings, and so forth and so on. All assets, all fixed assets have been added. Lakini kama they're broken down, then you have to express each of those assets as a percentage of sales. Like in this one now, you simply take the total assets of a sales times 100 because we don't have a breakdown of the other assets. Oh, they are there. Current assets, ingine ziko. Current asset kuna stock. Hapa iko namna gani? Hii 3 ni hapa chini. 3 kwa hapa. If you have your question paper with you, you can confirm. 2, iko namna hiyo. Current assets, yes. We have stock, 3 debtors, iko mbili. Yes. Total current assets,
5.
Current assets iko ngapi? 5. So nafikiri okay, fine. Those are the current assets. Current liabilities, moja tu, creditors.
Yeah.
So working capital, 5 minus 6, working capital minus 1.
Yes.
5 minus 6, hiyo inakuja minus 1. So net assets 12. Financed by ordinary share capital 4 million, retained earnings 6 million, long-term debt 2 million. The total is 12. Iko namna hiyo.
Yeah.
And then you're given additional information. You guys are given additional information. 1, sales in the year ended 31st December 2009 amounted to 20 million. I remember this is the most recent year. Hii tarehe umepewa hapa tafadhali inakuonyesha this is the most recent year 2009. So that means these are sales for the current year. The sales for the current financial year, sales for this cannot be current. Sales for the year ending that 1st December 2010 are expected to increase by 4 million. Oh, does that mean hata amekupatia increase in sales? So that means the total sales for the year 2010 is ngapi? How much are the forecasted sales for the year 2010 now? Total?
24 million.
24 million, si ndio?
Yes.
Kama sales for the current year is 20 million and sales will increase by 4 million. It then means total sales for the year 2010 are forecasted at 24 million, si ndio?
Yes.
But if you take 24 minus 20, you'll find the increase in sales. Number 2, the after-tax net profit margin and retention ratio for the year ended 31st December 2009 were 80% and 30% respectively. These ratios are expected to be maintained in the foreseeable future. That means when we are doing forecasting, we'll assume that the after-tax margin is 8%, the retention ratio is 30, meaning the payout is what? Dividend payout? 70. Ndio. Kama retention is 30%, it means the payout is 70. This, in the event that these ratios are not given to you, please remember the formulas I gave, look for them. The after-tax profit margin, dividend payout. You may not be given these formulas, these ratios. You may be required to work them out and use them in forecasting. These ratios are expected to be maintained in the foreseeable future. All assets and the current liabilities are expected to change in the current year ended at first current year. 2010 current year kweli. Hata kwa question paper imesema current year.
Yes.
Yes.
Hiyo kweli mnakubaliana hiyo? 2010 current year. Mnakubaliana hiyo kweli? 2010 there is a forecasting, isn't it? Current years in 2009. And this company is forecasting financial requirements for the year 2010. So how can 2010 be a current year? Hiyo sio, hapo kuna shida kidogo Ama nyie muone kuna shida hapo? All assets and the current that are expected to change in the year ended 31st December 2010 as at the same percentage as the change in sales. Now, of course, there is nowhere the examiner has mentioned percentage of sales method. When you read through the question, it's you to conclude that this question is testing on the percentage of sales method. Mnasikia hapo Examiner hata kuambia percentage of sales. By reading through the question, it is you to infer that in the light of the information supplied, examiner is testing on the percentage of sales method. Number A, amount of external financial requirements for the year ended 31st December 2010 through the issue of a debenture, to be raised through the issue of a debenture. Should I have given a corporate through the issue of a debenture? Ile existing debenture iko na corporate ya ngapi? Long hakuna. Tuachane hiyo, mimi sitaki kuleta siku mingi ya kuwasumbua akili. Naanza kusema huyu mwalimu hajui bando zetu zinaisha. Mimi sitaki kupata kazi tafadhali. Through additional long-term debt. Through additional long-term debt. Aje niseme hivyo, but tutaongezea kwa ile nyingine. Haya, a pro forma statement of financial position, a forecasted. A forecasted. It is a forecasted. Forecasted inaandikwa namna hiyo. A forecasted pro forma statement of financial position as at 31st December 2010. Namba C, hiyo iko. Mimi ndio nimeleta hiyo hata sijafanya mimi. Hiyo ndio exercise mtafanya baadaye. Those ratios I have not worked them out. But at least you'll have something. An exercise to do in the course of the day, Using the results obtained in part A and B above, compute the following financial ratios for the year ended 1st December 2010. Gearing ratio, fixed assets turnover. Gearing ratio, what's the formula? Nani anaweza kumbuka? Nani anaweza kumbuka formula ya kutafuta gearing? Fixed assets turnover. Formula? Rate of stock turnover. Return on total assets, current ratio, quick ratio, dividend cover, dividend yield, earnings yield. Kama formula hakuna, too bad. Formulas, please have them on your fingertips. Briefly comment on the performance of the firm. In terms of profitability, efficiency, asset utilization, liquidity, capital structure, coverage, and returns from investment in equity shares. Hiyo swali zinakaa mzuri sasa. Looks a complete question, Zangu. Are we there?
Yes.
Tuko pamoja?
Yes.
Ama wengine wamelala.
Yes.
Wengine some are chatting with their boyfriends and girlfriends, of course. Amount of external financial requirements for the year ended 31st December 2010 through additional long-term debt. I've already answered this. This is an answer. So external financial requirements for the year ended 31st December 2010. Of course, it requires you to follow the steps. The first step is to find the increase in sales. Hiyo ndo tulikuwa tumepewa, si ndio? Hiyo tulikuwa tumepewa na examiner. Kuna kazi ngumu hiyo, si ndio? Exam.
Yeah.
Hiyo examiner was very fair. Akakupatia.
Yes.
Sasa in future unaweza utatafuta wewe mwenyewe tafadhali. Usifikirie atakupatia saa yote. You don't know if this concept were to be tested by any chance, so you might be required to look for the increase in sales. So I've simply taken sales. We saw the sales for the year 2010. Here itakuwa 24. What the figures in millions? Were they in million or thousands?
Million.
Millions.
Huh? Kweli? Sio thousands?
A million in thousands.
Oh, sasa hapa itakuwa, wacha niseme thousands hapa, si ndio? It is 24 million, si ndio? 24 million, 20 million, eh? Angela.
Yeah.
Yeah, Angela. How are you? Tumeamuka. Sasa sales for the year 2010, 24 million. Sio tumeona? Sales for the year 2009, 20 million. So increase in 4 million, eh? Si ndio? That is the first step. Remember that was step number 1? Determine the increase in sales a firm expects to realize during the forecasting period. Number 2, determine the incremental total assets that will arise due to increase in sales. Now, for us to be able to find the incremental total assets, then we need to express all assets as a percentage of sales. Current relationship. Hiyo sentence sijui inamaanisha nini. Zuri. Niseme all assets in the current financial year. Current financial year ni gani? 2009, eh? Expressed as percentage of sales. All assets in the current financial year 2009 expressed as percentage of sales. Expressed as percentage of sales. Of course, we need to know what relationship exists so that we can use it in forecasting total assets. Sasa mkiangalia kwa hii swali, fixed assets were not broken down. Si ndio? Unaona? What you're given is the total fixed assets, eh? So we'll take the total fixed assets over sales. Otherwise, if you have individual assets, please express each non-current asset as a percentage of sales. As a fixed assets, ilikuwa ngapi hiyo? Kwa swali, is it 13 million?
Yes.
So how much are the sales for the year 2009?
20 million.
Divided by 20 million times 100. Hiyo ni 65. Please confirm for me these figures. Eh?
Yes.
Fixed assets over sales times 100. Hiyo ni 65%.
Yeah.
Yes.
Which is the other asset in that statement of financial position? Current assets are broken down. Inventory, 3 million, divided by sales for the current year. Debtors, 2 million, divided by the sales for the current year. Sasa hiyo ni ngapi? Hizo ni workings, Inventory is 3 million divided by 20 million times 100. Hiyo unapata 15.
Yes.
Yeah.
Debtors ni 2 million divided by 20 times 100. Hiyo tunapata 10.
Yes.
Ukiongeza hiyo yote tatu unapata ngapi?
90%.
90%. So
Yes.
if I say the total assets of a cell times 100 is 90, that's okay, isn't it?
Yes.
Kuna mtu ameshangaa kwa nini nimefanya hivi? I hope that one you can see, isn't it? So if we rearrange the formula, then it means 90% of cells is total assets, isn't it? Sindio? If you make total assets the subject of the formula. Sio ni kweli?
Yes.
Kama ni mambo yangu naongea hapa.
Ni ukweli.
Hiyo ni kweli.
Yes.
Hence, kwa nini naandika ndogo namna hii? Nini imefanyika hapa? Hence, incremental. Incremental. So we can take the incremental estimation, Incremental total assets should equal to what now? 90% of what? Wale wananifuata mzuri?
4 million.
Incremental sales, Ni formula naandika tafadhali, Kwanza tuone. Tuweke formula tuone. Ndio tuone vile kutaenda sasa tukielekea hapo mbele. Sasa hiyo formula zinakaa namna hiyo. If you take the incremental estimation, then we conclude, you conclude that incremental total assets is 90% of incremental sales. That's the first thing that I want to establish here. Incremental total assets. Tunakuja kwa hii schedule yangu hapa. External financial requirements for the year ended 31st December 2010. Tunaona niko na columns mbili, hii column na hiyo, So incremental total assets is 90% of incremental sales. Tuliona incremental sales ni 4 million. Ni 90 ama 80?
Yes.
The percentage 90 ama 80?
90.
So 90% of incremental. Remember, I'm looking for incremental what? Assets. Not total assets. Incremental. Wacha nipige kelele kidogo,
Okay.
Hiyo ni incremental, So must be based on additional sales. 90% of additional sales, is it 3.6 million?
Yes.
Yeah.
Incremental current liabilities. Hiyo ndio step number 3. We have to express all current liabilities as percentage of sales. This is working number 3. Existing relationship between current liability and sales. Fine. I think current liabilities zilikuwa tumepewa ni moja tu.
Yeah.
Creditors,
Yeah.
As divided by sales. Current year times 100. Hiyo ni 30%.
Yep.
So that means current liabilities is 30% of sales. And if you go further, you can say now, hence, incremental current liabilities should equal to 30%, times incremental sales. You know, the approach is based on the assumption that a relationship exists a direct relationship exists between assets and sales. A direct relationship exists between current liabilities and sales. That's why we are doing this, ladies and gentlemen. So incremental current liabilities, 30% times, oh, sorry. Sales, Ninyi tamuoni mnisaidie? Sasa mimi niko kivyangu tu hapa. So we know incremental sales. So we simply take 30% of 4 million. Si ndio? Naona hiyo working nimefanya hapo. 30% of 4 million. So incremental liabilities is what?
1.2.
Current liabilities. Now, we said that increase in assets reduces cash flow, isn't it? Or you can look at it from another perspective, that increase in assets require financing. This company requires to raise 3.6 million. So. And they have already raised from the short-term sources 1.2 million. Hiyo ndio kwa sababu nimeweka brackets. Mliniambia increase in liabilities is an inflow, isn't it? It's the money the company has raised from the short-term sources. If they're looking for 3.6 million and they have raised 1.2 from the short-term sources, what deficit exists? These people are looking for 3.6 million to finance their assets. They have raised 1.2 from the short-term sources. How much more are they looking for? 2.4 million, isn't it?
Yeah.
Now, how is this company going to raise the 2.4 million? We check retained earnings for the year ended at 1st December 2010. Remember, the method is based on the assumption that the firm cannot go to their reserves. Do they have reserves? Ukiangalia hiyo balance sheet, the current year, sikuna reserves, si ndio hii? Ya 6 million. Kuna existing retained profit. Sasa, they cannot go in and finance from there. What they need to do is check how much to be retained at the end of the forecasting period. So that's why I'm saying here, retained profit for the year ended that 1st December 2010. Forecasted retained profit. So we need to start by establishing the forecasted net profit after tax. Mimi nafikiri wenzangu hapo mnaona mzuri forecasted. Hii ni 1 year's time from now, si ndio? So net profit after tax, we know the after tax profit margin, isn't it? How much is the after tax profit margin? Kiangalia additional information number 2. How much is the after tax profit margin? 80%. How do you arrive at the after tax profit margin? Formula gani? Net profit after tax. This is after tax profit margin. So you take net profit after tax divided by what?
Sales.
Times 100. Net profit after tax divided by sales times what? 100. Sasa ukitaka kupata hiyo net profit after tax, what do you do? Ngoja niende kwa my blackboard. Ndio watu wengine wamelala. Net profit after tax over sales times 100. That is how they found 8, sindio? So yes. Profit after tax should be 8% times sales,
Yes.
Which means now we are looking for profit after tax for which year?
2010.
2010. That means we shall take 80% of sales for which year? 2010, eh? Sawa.
Yes.
You are forecasting profit after tax for the year what? 2010. So 80% of sales of that year. And please take note, I'm not talking about additional sales now. Nafikiri mnaona hapo, eh?
Yeah.
Nafikiri mnaona hapo. Mimi sisemi additional sales hapa. I'm saying 80% of what? Sales, total sales for the year,
Sales.
so that I can find total profit after tax for that year. So I'm not looking for additional profit after tax. Otherwise, if you take 80% of additional sales, what we'll be getting is additional profit after tax. Please note, I'm not looking for additional profit after tax. I'm looking for total profit after tax for the year. Are we together there?
Yes.
Yes.
Yes. If we are together, wacha mimi nirudi kwa swali yangu, endelea na stori zangu. Yule amelala, wacha yeye endelee kulala. So 80% of what now? Is it 24 million, eh? Which is total sales for the year 2010. 80% of 24 million ni ngapi?
19, 20.
Huh? Those are the forecasted net income for the year.
Yes. Into it.
Okay, now this question ilituambia mzuri na very clear, ilitueleza hapa that the after-tax net profit margin and retention ratio. So 30% is retention ratio, meaning the dividend payout is what? If the firm retains 30, that means 70% is shared, isn't it?
Yes.
Sasa hiyo ndio nasema hapa 1 minus 30%, because I'm looking for proposed dividends. 70% of the forecasted net income of 1920. Is that 1344?
Yes.
Yes.
So then how much will be retained? Forecasted retained profit? Actually, this is forecasted. Forecasted retained profit inakuwa ngapi?
576.
So that's a source of inflow, isn't it?
Yo.
Kama wata retain hiyo, si hiyo itasaidia finance this increase. So the assumption is that the forecasted retained earnings will be used to support the increase in sales. So what shortfall? Is there any shortfall again? Now, how much more are they looking for? Sasa kama walikuwa nataka 2.4, wame retain 576. I can finance this increase in assets. So what shortfall is there now? If you take 2400 minus 576, una shortfall ya ngapi?
1824.
1,824.
1.824 million, eh? Hiyo ndio bado ile wanataka now, which we are told will come from where?
External financing.
Oh no, long-term debt, eh? I think is the question clear? Mimi ndio nimeweka hiyo maneno. Swali inakwambia hivyo. Swali inasema mambo ya long-term debt. Ama imenyamaza tu? Ha? Hapo kwa past paper imenasema?
Imenyamaza.
Nyamaza.
Nimenyamaza. Ndio nilikuwa nasema ikinyamaza namna hiyo, you are allowed to assume, eh? And I said more often you assume is a long term, is a loan they have gone for, eh? Okay? Long term debt. Sasa hiyo tumemaliza part A. Part A ilikuwa inauliza nini? Amount of external financial requirements think I should have said external long-term financial requirements. When we back to you for the year ended at first through additional long-term debt. A forecasted pro forma statement of financial position as at 31st December 2010. Forecasted. Hiyo. Forecasted statement of financial position as at 31st December 2010. Forecasted non-current assets. Sasa hapa, those items which have a direct relationship with sales, is all we have to be a bit careful again. Muliona, we said fixed assets over sales times 100. You need to pay which percentage? Do you find 65%?
Yes.
Now, if you are looking for fixed assets, it acquires 65% of what? Sales, isn't it? If you express fixed assets in terms of the rest, then fixed assets should be 65% of sales, Senior? You are looking for the total fixed assets of which year?
2010.
2010. So it should be 65% multiplied by sales for which year?
2010.
Now, ladies and gentlemen, please take note. Again, I am not saying additional sales. I'm only saying 65% of what? Sales. So that I can find forecasted fixed assets for the year 2010. Are we together? And this applies to all other assets and current liabilities. So that's one of the reasons why I was saying it's good to have those percentages. Okay, so fixed assets, percentage tulipata was 65% of sales for the year 2010. Does it give us 15.6 million? Hiyo percentage mnakumbuka? Hiyo percentage ndio hii. Tulikuwa tumepata 65% times total sales for the year 2010. Does it give us 15.6 million? Sasa unajua if you take time confirming, nyinyi ndio bando zenu zinaisha. Mimi niko kwa wifi.
Yes.
Unajua mimi niko kwa wifi. Bando zenu zinaisha. Au mimi?
Umesikia tu?
Hiyo answer iko sawa?
Yes.
Okay, let's now forecast current assets. Current assets, there were two, isn't it? Stock over sales times 100, tulipata which percentage? 15.
Yes.
So that means the value of inventory will be 15% of sales of the year 2010. 15% times total sales of the year 2010. You need 3.6 million.
Yes.
Higher. Debtors, we want what percentage? Debtors.
Yes.
10%, isn't it? So 10% of total sales of the year 2010, the year inatupatia 2.4 million.
Yes.
So total current assets, when you add, the year inakuwa ngapi? 3.6 plus 2.4 million ni ngapi?
6,000.
I think it should be million, isn't it? Plus 15.6 million, does it give us 21 million total assets?
$21,600.
Oh, kuna hera?
Yes.
Nani huyu ameona haraka hivi? Huyu jamaa ajalala huyu. Huyo ndio ajalala tu hapa. Kingine wote wamelala, including myself, Haya, total iko sawa, 21,600.
Yes.
Now, there is one very important observation that you want to make here. You can know whether you are right or not. You can know whether you are on the right track or not. whether you're on the right track. How much was the increase in assets? We expected assets to increase by how much? Increase in total assets.
3.6.
How much were the total assets in the current year? Total assets in the current year zilikuwa ngapi? Hiyo ni 13 plus 18, eh?
Yes.
Current assets 5 million plus 13, hiyo ni 18, eh? 18 ukiongeza the increase in assets. I mean, total assets, the current year is 18 million plus the increase. Increase ni 3.6. 18 million plus
21.6.
So you expect those are the total assets.
21.6.
So are we together?
Yes.
Are we right now? Looks like we are on the right track. Eh?
Exactly.
So that's something that you can counter-check immediately. Are you on the right track? If your assets are increasing by so much from the current assets, is it true? Financed by ordinary share capital? Ilikuwa ngapi hiyo? In the current statement of financial position, ordinary share capital ilikuwa ngapi? 4 million. Those in 4 million now.
Yeah.
Sasa hii 41 million imetoka wapi? Hapa kuna wazimu imeingia hapa, eh? 4 million. Eh? Hiyo ni 41 ama 4 million?
4.
Higher. Retained earnings. Currently, we have existing retained earnings of how much? Retained earnings currently in 6 million, eh? Isn't it? Existing,
Yes.
eh?
Yes.
Which are the additional retained earnings? The company retained how much extra?
576.
Yeah, forecasted retained earnings is 576. So 6 million plus 576,000, eh? Total retained earnings?
6576.
Yeah. Sindio hiyo mnaona hapo? Sindio hiyo?
Yes.
Sasa ordinary share capital plus reserves, shareholders funds ni ngapi?
10576.
Je, hiyo iko confirmed ama ni mambo yetu tu? Mambo yangu nimeanza kuleta hapa.
Confirmed.
Wewe tu ndio umeconfirm, watu wengine hapa wamelala tu. Mimi najua.
Iko sawa.
Iko sawa, eh?
Yes.
Yeah. Creditors. Okay, let's look at current liabilities. That's another financing activity. The percentage we found, that's an item that is assumed to have a direct relationship with sales. 30%, eh?
Yes.
And that's the only current liability that exists. So 30% of total sales for the year.
7.2.
Current liabilities, eh? Kuna underlining iko hapo na najaribu kutoa inakataa, sijui. Things in someone typed for me long years ago na sijui alikuwa anafanya nini. No, I wanted to do, actually, I will be doing a book in FM. I want to finish doing a book in advanced FM. Hiyo zimetanunua nyinyi? 65, 76. Huh? Huh? By the way, I'm doing a book in advanced FM, a very good book, eh? Advanced Financial Management. Mkikuja section 5.
Congratulations.
The next 3 months, hiyo kitabu itakuwa. Nyinyi mkikuja section 5 itakuwa tayari, eh? Simtanunua?
Yes.
Itakuwa jibu sasa mimi sijui publisher. Already imeenda 500 pages. My book is already 500 pages, eh? And I've explained each and every concept, eh? Sio kitu nilianza jana, ni kitu nilianza pole pole. I've been doing it over time. And because there's a problem in advanced. Huh?
Congratulations. We are waiting for it.
It is for you guys. See, nataka was idea. Mununue.
Yes.
Some. Yeah. By the time nyinyi mtakuwa section 5 lini next semester? Nyinyi mko section 3 bado. Mtakaa kidogo. But probably by the time mnafika section 5.
Next.
I'm finalizing. I'm finalizing it. Probably by the time you'll be in section 5, itakuwa ready. Mtatumia kwa CPA na mkienda kama hujafanya BCom bado. I've captured the content in most topics in BCom finance. Those who will be specializing in BCom finance. I know the book will be very useful for you.
Okay.
Nikishamaliza section 5, I'll go back and do another basic book for section 3. That's why you can see I'm editing here. Hii nikimaliza, I'll copy and paste it to my book. Hata section 3 iko, naendelea tu pole pole. But let me finish with section 5. Nikishamaliza, nitakuja section 3. This is a small book. Advanced financial management has been a headache. Wanafunzi wanaanguka, inawasumbua. So let's see if we come up with something. Probably naweza saidia. Because you never know. If this corona killed me, ningeenda na hiyo knowledge yote. So sometimes it's good to put it down. Hata ukiondoka na wachia watu hapo. This corona is not easy. People have been dying here, right, left, and center.
You are lucky.
Yeah, so we should thank God. Tumefika wapi sasa?
Tulikuwa kwa swali yetu huko kwa liabilities.
Oh, yeah. So creditors, 30% of 24. You 7.2 million,
Yes.
Can you confirm?
Yes.
Now, long-term debt, how much are existing in the company's capital structure? How much is long-term debt existing? Kiangalia. Existing ziko ngapi? 2 million,
2 million.
Na hawa wameenda kuchukua ingine ngapi? Hii hapa chini. External financing. We have assumed long-term debt of 1824,
Yes.
Sasa total ni ngapi?
Yes.
Total ni ngapi?
21.
38, 24.
So the total long-term liability is 38?
24. Yeah.
Sasa hii ukiongeza yote inakuwa ngapi? 21,600. Sorry. 10,576 plus 7,200 plus 38, 24.
21,600.
Hiyo balance sheet iko na shida kweli?
Hapana, iko balanced.
Yeah. Sawa. So I hope that concept is clear. But I have added another question here, which you can answer now, isn't it? I want you to compute all these ratios from the results we have obtained in A above. Tafadhali angalia zile formulas nimewapatia na mtafute, si ndio?
Yes.
Hii sinitumia tu formulas, hii ina mambo mingi, tafadhali. Okay?
Okay, you will try.
Unless there is an issue, I think, ladies and gentlemen, that concept is done. I want to request that you read cash budgets. And Mwalimu is done with the working capital management, isn't it?
Not really.
Kwa nini? Is there an issue in working capital management that you might want me to look at?
Yes.
An issue that perhaps you feel I should look at? We cannot do the whole topic because time is not there, but if there's an issue that you think I can go through in working capital management, let me know through your class rep. Huh?
Credit policy.
Huh? Your management of debtors.
Yeah.
Okay. Evaluation of a credit policy. The change of policy.
Change of policy.
Oh, okay. Okay, no problem. Then probably I should create time next week. Maybe Tuesday evening, eh? So that I can go through that concept. Eh?
Please do so.
You guys have done working capital financing policies, isn't it? The aggressive, the conservative, and the matching policy, isn't it? You have done working capital operating cycle. You have done management of stock. And management of stock, please be very careful on methods, techniques of inventory control, like economic order quantity, just-in-time system, and ABC analysis. Eh?
Okay.
Especially the economic order quantity. Eh? Use mmesoma kwa management accounting.
Yeah.
Economic order quantity, tafadhali go through it very, very carefully. Eh? Yeah? The economic order quantity, finding the EOQ, finding the total relevant cost, finding the reorder levels, and so forth and so on, eh? Isn't it? The just-in-time system and ABC analysis. Also, management of cash. Please be careful with the Baumol's model, the Miller-Orr model, and the cash budgeting. And then management of data is what you are telling me. How to evaluate and advise whether a company should change their terms of sale or rather change credit policy. There's a way in which you need to do the analysis. Eh? And of course, generalized areas. Now, please also read on Islamic finance. I'd given you a handout on Islamic finance. Actually, there were two. And I also gave you documents to read on financial institutions and markets. So tafadhali, financial institutions and markets, hiyo jisomee. Hakuna hesabu hapo hata moja. Islamic finance, tafadhali jisomee. Na msome all that you have gone through. All that you have gone through. Okay? Ukipitia yote tumefanya, hii mtihani, I know we expect awards from this class. 2 or 3 awards. Tutatoka kwa hii class, eh? Sindio?
Yeah.
So, if you want me to go through the concept of evaluation of credit policies, then I can arrange and do it on Tuesday evening. I hope that is acceptable. Eh?
Yes.
Yeah.
Mimi niwachie hapo sasa. Na mimi nipumzike. Eh?
Nice weekend.
You too. Enjoy. Okay. Now, this document again, I'm going to put it in Moodle. Eh? That's just a document. Eh?
Okay.
Muipata kwa Moodle. Eh?
Yes, and the WhatsApp group.
Send on WhatsApp.
Mimi wacha niweke kwa Moodle. Ninyi mpeleka kwa WhatsApp nyinyi wenyewe. Mimi wacha niweke kwa Moodle. Eh?